Good day, good afternoon, and good evening to all of you tuning in from around the world. If you're watching this live, welcome, and thank you for joining us for this exclusive collaborative webinar featuring Jim Bianco and hosted by Reuters Events and the CMT Association. If you're watching this on demand, you're one of over 1,000 people who have signed up for the session's recording, and I hope that you'll enjoy Jim's session. First, I wanted to introduce Jim. As president of Bianco Research, Jim has been a source of objective research and unique insights into financial markets for over 20 years. Jim combines cutting-edge analytics and a highly visual approach to provide objective, data-driven analysis and market commentary on the latest themes in financial markets. Jim is an advocate of technical analysis and joins us today as a representative of the CMT Association of Chartered Market Technicians. Now, a little about the CMT Association, which is a nonprofit global professional organization of technical analysts headquartered in New York City and with a presence in almost 80 countries worldwide. Jim, it's an absolute pleasure to have you here with us. And that being said, I will now cede the stage over to you.
Thank you. And good morning, good afternoon, good evening to everybody who's joining us. I have some prepared remarks on the macro fixed income outlook. Excuse me. And there is a window open here for Q&A. So go ahead and shoot your questions in. I'll do my best to try and capture them real time. And those that I miss, I'll leave a Q&A session for at the end. As far as what I want to discuss, macro fixed income outlook, I want to talk about three topics in general today. Topic number one is where I think the bond market is. I have been, just so you know where I've been, for 20 years, I've been standing on the rooftop screaming bond bull, bond bull, bond bull. And I think that the 39-year bull market in bonds ended March 9th, when we hit 33 basis points in the 10-year note. I think the next move higher, the next move in yields is going to be higher. And I'll discuss that as well too. I think we're finally going to start to see a resurgence of inflation. That is the basis of my thesis. And I'll explain why I think that that's going to be the case as well too. And the role that the Federal Reserve with quantitative easing is playing in the bond market. It is a substantial one right now. The second part I'd like to discuss is the state of the economy and how that plays into it. The economy has largely, the recovery has largely stalled in the economy, probably around mid-June to early July. We haven't been going anywhere, excuse me with this cough. And we haven't been going anywhere with this recovery. And I think that the recovery is going to stay stalled as well too. That's why you saw yesterday and today, markets have such a huge reaction to every twist and turn about fiscal stimulus, or as I called it, the federal government money cannon. They need it badly because the economy's recovery is not proceeding as we would like. It's not reversing, but it's just not getting better than we like. And third, and I'm going to tease this a little bit, I want to talk about a big upcoming event for markets, and that's the election. And I'm going to tease it, and I'm going to tell you, I have a different view than a lot of people have on the election. I think that investors are discounting something different than the polls. And I'll just leave it at that. And you'll have to just wait a few minutes for me to kind of, explain that as well we go here. All right, let me start with the bond market. Let me start with the bond market. Here is a long-term interest rate chart of the U.S. By the way, I can illustrate on this, so you'll see me draw on the screens, of the 10-year yield. It peaked on September 30th at 15.84%, and it's been in a 39-year bull market of falling interest rates until recently. Zeroing in on it as well, and I'll come back to the other chart as well. Here is March 9th, right here. We hit an intraday low of 0.33%, look at those bar charts that you have right there. Those are by a lot of measures, those are the biggest range days in the history of the bond market. March 9th, March 16th, March 23rd, in that range right there. Biggest days that we've ever seen in the history of the bond market in terms of ranges. But I think that that was the low. The bond market has been trading in a very narrow range that we've seen for the last several months. And that range even got more narrow in September. And there is indications that we might be breaking out of that range right now. Along the way, here is the MOVE index. The MOVE stands for the Merrill Option Volatility Estimate. This is the VIX of the bond market. It hit its all-time low last week. So you've had extraordinarily low and tight volatility in the bond market. So volatility tends to be mean reverting. Low periods of volatility give way to high periods of volatility. The bond market is a little different than the stock market. Typically, the stock market has what we refer to as an investor skew, right? Higher volatility always seems to come about with lower prices, and lower volatility seems to come about with higher prices. In the bond market, like in the commodity markets, higher volatility can equally come about because rates are going down a lot or up a lot. So I do think that this bond market, going back to this chart here, is a wound spring and it is ready to go. Now, ready to go doesn't mean that it is breaking out now. It might be, or it might be spring. But I do think that we're getting ready to have a launch in a big move. I think that that big move is going to be up. My other fun chart I'll show you here, and then I'll explain why I think that that's up in yields. So when I refer to bonds, I am referring to yields. The other fun chart I'll refer to here is the total amount of negative bonds outstanding in the world. That peaked in August of last year at 17 trillion. It's 15.5 trillion right now. I don't think we make a new high on this chart. I think that the next move is going to be down in terms of negative yielding bonds, because I think the next move in yields is going to be up around the world. Why do I think that yields are going to go up? I am an inflationista. I've been looking for a theme song for inflationistas, or people that think inflation is going to come back. That's new for me as well, too. I was never on the inflation camp until very recently, post March 9th, actually. And I do think it's going to come back. Now, some of the evidence I've got. The bond market is ignoring Dr. Copper. There's an old saying in the bond market that Dr. Copper has a PhD in economics. It really seems to predict where the market's going to go next. So what you're looking at here is the blue line is copper prices, and the orange line is the 30-year yield. This is the 30-year yield in this case. They seem to follow each other, but lately, since about May, since that very tight period in the bond market, copper and commodity prices have been moving higher. Normally, the bond market moves contemporaneously with commodity prices. Contemporaneously means that one doesn't lead or lag the other one. They kind of move together, so you can't really make money. If I figure out what commodities are going to do, or if I wait for commodities to move, then I could make money in bonds, or vice versa. They seem to move together. There has been a divergence between the two right now. Copper prices are moving higher, but we're not seeing that. And if you actually, if I drew a similar chart of this, of the broad-based commodity indexes, you'd see something similar too. This is the five-year forward inflation break-even rate. Now, what is this? Excuse me, if you're not familiar with the intricacies of the Treasury inflation protected securities market, there are real rate bonds. They do trade on what the inflation rate is going to be. There is a 10-year real rate bond. There's a 5-year real rate bond. By subtracting out the 5-year from the 10-year, you can get an estimate of what the market is pricing for the inflation rate in 5 years for the next 5 years. Now, why would you use that measure? Because it gets rid of all the noise of crude oil prices and everything else. It's where is the trend of inflation? It bottomed March 19th, that mid-March period, which I think was the most significant period. I believe will ultimately go down as the most significant period in the bond market since 1981. And inflation expectations have been moving higher as well too. But as my bond chart shows, Bond yields are not reacting to copper. They're not reacting to inflation expectations. They're not reacting to any of this stuff as well, too. But I believe that ultimately they're going to start to react to coming inflation. Now, why do I think inflation is returning? And I'll stop here and I'll say it has nothing to do with the Federal Reserve. It is little to do with the Federal Reserve, but that's not the primary driver of my story. I think my story's got twofold to it. One, excess supply has been greatly diminished. So this chart here shows you real GDP on a log scale, and here's all the recessions as well too. Real GDP has fallen from 19.5 trillion to 17 trillion. In other words, the drawdown in the economy, the contraction in the economy through the second quarter was 10%. How do I put that number in perspective? Remember the Great Recession and how bad that was? That was 4%. This is 10%. This recession is 2.5 times worse than the Great Recession. Only the Great Depression in American history has been worse than what we've gone through. We are making less stuff than we were making a year ago. And by the end of the second quarter, we were making 10% less stuff than we were making a year ago. In economic terms, this is massive. I've heard people say, and I want to be clear on this because this has been one of my things I've been yelling about with the economy. Oh, but the economy's back to 95% of where it was. That's a disaster. That is a disaster, 95% of where it was. Other than the Great Recession, recessions would be that the economy would lose 1% or 2% of its capacity. And that was a recession. The Great Recession, which scarred everybody 10 years ago, it lost 4% of its capacity. If you're telling me it's lost 5% of its capacity and acting like that's a rounding error, you don't understand the economy. That is a big drawback. That is a big drawdown. We are making less stuff is what we're doing. So whatever excess capacity story, that has largely been pushed away to some degree. At the same time, we are stimulating the hell out of the economy as well too. So this chart here you're looking at is the US federal deficit. As of August, the September numbers aren't out yet. I think they come out this afternoon, but they're not going to change that much. But as of August, we had a 2.9 trillion with a T dollar deficit, which was equal to 15% of GDP. The only time we could find that the deficit to GDP, this chart goes back 50 years. We've seen nothing close to that. It's much larger than it was during the Great Recession. It's much larger than the period in the 80s when we were all fretting about the deficits under Reagan. In fact, it's 3 times larger than that right now. The only time it's larger than that, a deficit to GDP, was the Civil War and World War II. This is about equal to World War I right now in terms of the deficit as well too. So we are spending a lot of money to try and $600 a week, $1,200 payments, bailouts of the auto industry, bailouts of the airline industry, and the like, to try and keep spending as high as possible. And what is the talk out of Washington right now? Are we going to get more spending? You've reduced the supply of stuff. You're artificially stimulating demand. That means higher prices. And that you should suspect higher prices coming over the next several months, excuse me. And that's exactly what I think we're going to get. The next chart you're looking at here is core PCE. This is the the Fed's favorite measure of inflation. It takes out food and energy. It's personal consumption expenditures, not CPI. I'm using the Fed's measure because we want to know when the Fed's going to react. Core PCE is at 1.25 right now. It's bottomed in April and it started back up. When I say inflation is going to come back, I know some of you are probably older and say, oh, the 1980, 8, 9, 10% inflation, or something along those lines. I think that we're not looking. I don't think we're looking at those types of numbers. Here is here is 2.5% on the chart. I think if we get, and I think, let me say it this way. If we get inflation on core PC back to 2.5%, and most of you think, 2.5%, the Fed wants that. They're cheering for that. They think that's a good thing. That's a 28-year peak, 28-year peak in inflation. And I think that if we were to get back to that level, we would see it start to move from there. What I mean by move from there is, let me also point out the other thing about inflation. On a 3-month annualized basis, through April, you had the largest decline on a 3-month annualized inflation for inflation in the last 30 years, worse than what you saw during the Great Recession, worse than you saw after September 11th. You've had a big bounce back. That the annualized rate over the last 3 months has been 3.5%. I suspect that that's going to be a little stickier. It's not going to stay 3.5%. But I do think that when we get into the middle of next year and you get past the shutdowns, the year-over-year changes in the inflation rate are going to start to move higher, and that's where we're going to go. Now, we go to slide 13. Where's the Fed fit in on all of this? The Federal Reserve has been engaged in massive quantitative easing. There's a question here about, do you expect institutional investor flows to get out of bonds, gold, and go all into equities in the midterm, including an evolution of investment mandates? Let me say this. I'm going to talk about what the Fed's doing. They're 100 times larger than what investment flows are doing right now. March 13th, the Fed has announced on March 13th that they would start quantitative easing. They have bought 3.3 trillion with a T dollars of bonds in the last 6 months. $3 trillion of bonds in the last 6 months. The flows into bond ETFs has been about 11 billion versus 3 trillion. The Fed bought, as this chart shows you here, on Monday, the Fed bought $12 billion worth of bonds on Monday. They bought more bonds on Monday than has been the total inflow into ETFs all year. So the Fed has been actively squashing down interest rates with their massive purchases of over 3 trillion of bonds. Now, some of these are short-term bonds, and some of these short-term bonds do mature. So if you look at the Fed's SOMA portfolio, System Open Market Account, the size of their portfolio, the Fed now owns $6.39 trillion worth of bonds. 3.77 of that is notes and bonds. 197 of that is mortgages. So they have a $6.4 trillion portfolio. They're larger than BlackRock. They are the largest money manager in the world right now. BlackRock would be the largest private sector money manager in the world as well too. And so they are actively squashing down inflation. The Fed, as slide 15, has bought so many bonds. This chart here shows you the market value of the Barclays, Bloomberg, used to be Lehman, if you're old enough in the bond market to remember this, market value of the index. In other words, how big is the bond market's investable universe? And what I did was I subtracted out the Fed's board purchases of securities. The bond market has been shrinking this year. It is smaller now than the beginning of the year. Even though we're running a $3 trillion deficit, the bond market has gotten smaller than it had started the year. So you're seeing a lot of squeeze in the bond market because of the Fed. Now, if I'm wrong and we don't get inflation, then the Fed could keep buying trillions and trillions and trillions of dollars of bonds as we go forward from here, and there would be no consequence. But if all of this, remember, they're buying bonds to stimulate, to send out checks, to increase money in everybody's pocket. Trump proposed this morning that, $35 billion for the airlines, $400 a week for everybody who's an extra $400 a week for everybody who's unemployed. And we're going to just mail a $1,200 check to everybody who can fog a mirror as well. That increases the deficit. That is what the bond purchases will help do, is to keep interest rates under wraps as well too. And so that we've seen that big decline. I have likened the bond market to something similar to, the analogy I've used is the Fed is a post in the ground. And the market is a horse tied to that post. And the horse is just sitting there tied to the post, not going anywhere. But if that horse gets spooked, say inflation spooks that horse, it will rip that post right out of the ground and run wild. So the Fed has got the bond market under control, keeping it down. It's all stable. They're all talking about, let's throw another $1 trillion on the log here or $1 trillion on the log there. Send money out to these people, send money out to those people. There's no consequences. But if inflation becomes the consequence, then the bond market will rip that post out of the ground and it will run. QE is being done by Bank of Japan. It's being done by the RBA. We have seen instances of this. When the market gets an idea in its head, the central bank can't stop it. Right now, it doesn't have that idea in its head. But when and if it does, the central bank cannot stop it as well too. Somebody else says the Fed have a stop loss on its high yield portfolio. I'm just looking at some of the questions here. Do you think that yields can go up without inflation by an uncontrolled chain of defaults in the bond market? The Fed does not have a stop loss on the portfolio. Let me answer that question, and then I'll come into the other one as well too. The Fed is not allowed to buy high yield bonds. They're not allowed to buy corporate bonds. Well, how are they doing it? They're not. What it is that the Treasury has set up an investment fund, a special purpose vehicle, a shell corporation. They are purchasing the bonds. The U.S. taxpayer owns the high yield bonds. The U.S. taxpayer owns the investment grade bonds. The Fed is acting as their banker, purchasing it for them, is what they're doing. That's why when they talk about this, the Fed needs an act of Congress to buy equities. No, they don't. They just set up another shell corporation with Steve Mnuchin and start buying equities. They could have that done in a half an hour if they think it's necessary. They don't think it's necessary right now. That's how they're buying ETFs. They're not allowed to buy ETFs. The Fed is only allowed to buy things that are guaranteed by the federal government. So they can buy treasuries. They can buy mortgages because they're guaranteed. They can buy agencies because they're guaranteed. They might be able to buy munis that they don't yet, and that's unknown. No one's tested it. But they absolutely cannot buy ETFs, corporate bonds, high yield bonds. But they get around it because you and I, the taxpayer, are buying them through a shell corporation owned by the Treasury. So they're purchasing them for a government guaranteed shell corporation. That's how they did the sleight of hand in order to continue the purchases. So they don't have a stop loss. If there is an uncontrolled chain of defaults, you're going to eat it. I'm going to eat it. The taxpayer is going to eat it, is what's going to happen. To that end, that's why a lot of people have been arguing that you need to co-invest with the Fed, that you've had a booming year with corporate bonds, you've had a booming year with high yield, because the defaults will go away, the taxpayer will eat it, the Fed will purchase bonds on behalf of the taxpayer in order to prevent a big spread widening as well too. And so therefore you've got no risk unless you get inflation. If you get inflation, then every purchase becomes a bad thing. It becomes bad as well too. And then they will be encouraged to stop. Finally, let me go back to my chart here, chart 16, the Fed Fund futures forward curve. Here's what the market expects the Fed Fund futures market to do through the end of 2023. It's exactly what the Fed said. It's exactly what the Fed said they're going to do. Nothing. They're not going to raise rates for 3 years. I want to remind you of what happened in the fourth quarter of 2018. And in the fourth quarter of 2018, the Fed started talking about reducing the portfolio by letting the balance sheet decline by $60 billion a month. On December 19th, 2018, Jay Powell came out and said, the balance sheet is going to decline on automatic pilot. It is going to be like watching paint dry. The market freaked out. The Dow fell 600 points during his press conference in December of 2018, 3% decline, the worst performance for the market in history during a Fed press conference or a Fed event of any kind. As a matter, it kept selling off into Christmas Eve. And then on January 4th, Jay Powell came out in a speech and said, remember all that stuff about automatic, forget it all. Throw it all in the trash. We are now patient and flexible. The Fed will tell you that they are not going to raise rates for 3 years. They're going to give you all this automatic pilot stuff. Or not automatic pilot stuff. They're going to give you all this stuff about inflation and letting unemployment come back. And it's all going to be fine till the bond market freaks out. And then all of it goes in the trash and the Fed will start raising rates. But right now, the bond market is not freaking out. It hasn't ripped that post out of the ground and started running because there's still an open debate about whether or not we're going to see more inflation as we go forward from here. That gets me to my next chart. Let me start with economists' view of the economy. We know, let me back up. We know that the second quarter GDP, the shutdown quarter, was minus 31.4% annualized, 8% loss or something like that. The worst quarter in American history ever reported. We also expect that the third quarter is going to be plus 28%. That's what the consensus estimate is. The third quarter ended a week ago. The best quarter ever in American history, but that's just the rebound because we restarted the economy after the second quarter shutdown. The fourth quarter should give us a better idea of what the economy is doing. Here is the consensus estimate for the fourth quarter by economists. Back in June and in May, they were looking for more than 11% growth in the fourth quarter. That is eye-popping. Absolutely booming, eye-popping growth. Since June, it has been going straight down. It's now 3.5%. 3.5% would actually be a decent quarter, but that's assuming that this chart's gone down, stopped going down. This chart reminds me of the old joke about the window washer that falls off the 10th floor scaffolding. What's he say when he passes the third floor? So far, so good. That's what I think a lot of people say. Oh, we just passed the third floor. So far, so good. You haven't hit the pavement yet. We don't know where the bottom is on this. There are some economists that are suggesting that the fourth quarter might turn out to be a contraction before it's all said and done. Why is that happening? Let's look at some high frequency economic data to look at what's been going on with the economy. First, let's start with mobility data. If you're not familiar with mobility data, what that is that's your phone. The phone companies, the providers like Apple, Google, whenever you turn on location services, they track you. They do release this data, not individually, but in aggregate. How much am I moving around? How much are you moving around? How much does my phone travel each day? They calculate a mobility index. The mobility index, the Dallas Fed has done a very good job of taking all of the mobility index from Google, GDL, Apple, and aggregating them into one index. Here's the baseline is 0 of how much we were moving around pre-pandemic. Here's the shutdown, and we stopped moving around quite a bit. This is an index, so that's not minus 100%, meaning that you never left your house, but the index went down 100%. Then the economy reopened. That's your 28% quarter in the second quarter. But what you'll notice is in late June, we hit minus 39.5 on that index. We're at minus 37.6. We have stopped being mobile. We have not gotten back to where we were before. The way that works out, if you want to break that down, I didn't put those charts in there, is we are not riding public transportation. Actually, I have a version of that right here. The New York City subway. How many people are riding the New York City subway? There was about 5 million people that were riding the New York City subway daily before the pandemic. It went down to 200,000. It is currently at 1.6 million right now. We're roughly at 30% public transportation on the New York City subway system. And the next chart here shows you the number of people that are traveling through the airports. 2019 is how many people would go through TSA security a day in all American airports. It's around 2 million a day. The orange line will show you how many people are going through it now. This is a log scale. It was half a million or so on the 6th, yesterday, the day it was last updated. And so the gray line is a rolling 7-day average, 33%. The way the mobility is down is public transportation, buses, trains, subways, airports, airplanes, 1/3 the traffic we used to have. We're driving as much as we did. We're walking as much as we did, but we're not using any kind of mass transportation largely because we're not going back to the office is a big reason for that too. So mobility is down. We're not getting back to pre-pandemic level. Spending. This is Infinity. Infinity looks at credit card sales. We are still down from where we were pre-pandemic in credit card sales. Now we're not down as much. We were down by a third back by late March. We're still down around 4%. But this idea, if there's any kind of, the idea was there's supposed to be some kind of pent up demand for stuff, and that number was supposed to shoot higher. But more importantly, that also sort of peaked by late June as well. A lot of the spending came from $1,200 spending, $600 a week. That all ended, and we're still arguing about whether or not we're going to get more stimulus. So the economy is not seeing the spending levels that it was getting. Homebase provides logistical services for over 1 million companies. How many hours do your employees work? Your hours that your businesses are open, at the hours that your employees work. I said that one already. Homebase also put together an index. There's pre-pandemic, there's the shutdown. By late June, the economy stalled. So the point is, the economy stalled in late June. It has not gotten worse, but it is definitely not getting better. That's why you saw the economists' estimates are falling every day, because they're seeing that it isn't getting better and that they keep marking down their forecast. There is an expectation by people that, oh, that must mean that there's going to be a gigantic rally in bonds because the economy is hurting. That might be, but I'll say this about volatility. Come back to my volatility thing again. That when the market breaks, it could break in either direction. I think that for the equity market, the perfect scenario is the bond market, to go all the way back to my my move chart. The perfect scenario for the equity market is that the bond market's volatility stays down here. The worst scenario for the bond market, or for the equity market, is bond market volatility starts to jump in a big way. If rates fall a lot, if I'm wrong, and we go back to 33 basis points, the economy has taken a major hit. You could kiss earnings goodbye, and the market takes a dump. If inflation comes back and the bond market rips that Fed out of that post and it starts running wild with higher interest rates, the only thing that's going to stop higher interest rates is the Fed's got to stop all of its purchases. That hurts the market. The sweet spot is what we've had for the last 4 months. Low, stable interest rates that don't do anything, that a lot of people don't even think are viable investments anymore, as well too. So I do think that the next level is going to be higher. It's going to be inflation. It's going to come from more stimulus, less supply, more stimulus, no inflation, more stimulus, more stimulus. We're just going to keep going in a kind of an MMT world until this ends. Lastly, Open Table is another good one. It shows the restaurant reservations. We're still down a third on restaurant reservations US-wide than we were pre-pandemic. We're down 3/4 in New York City. And a lot of those restaurant reservations were for outdoor dining, and the weather's turning. So you should suspect that this is going to probably turn lower as well too. Finally, when I talked about the spending, they're going to do more stimulus. If Biden wins, they're just going to keep adding more and adding more and adding more. This is what they're going to do. They're going to just do stimulus. Stock market didn't blow up. Interest rates didn't go up. They're going to do more. Stock market didn't blow up. Interest rates didn't blow up. They're going to keep going till it does. And that's where I think we're going to go. Let me take you through a couple of charts here on what's going on with the election. A lot of you probably think this way. Here is the Real Clear Politics national average for national polls. Trump's at 42.2, Biden's at 51.2. Biden, I do this from the incumbent point of view, -9 because I do it from the incumbent point of view. Biden has a 9-point lead over Trump in the national polls right now. This is leading the poll analyzers. That 9-point lead is just what he's got in the polls. The poll analyzers. This is 538, Nate Silver. He's giving Trump a 17% chance of winning the election. And this is the Economist forecast, the Economist magazine. They're giving Trump a 10% chance of winning the election. Again, I'm going from the incumbent point of view. I'm not picking one candidate over the other here. According to the polls and according to the people that analyze the polls, the only thing you need to worry about is how big Biden's victory is going to be. It will be a Biden victory. How big is it going to be? Now, if you want to ask me the question, I'll stop it. Where were we on October 7th and October 8th of 2016? Exactly where we are right now. Hillary had about a 9-point lead. Instead of Trump being mired with COVID, stuck in the White House, he had the Billy Bush inappropriate comments about actresses tape. That was October 8th. And Nate Silver had him at about a 15% chance of winning the election. We are identical to where we were at this point in the previous election. But the pollsters say, we've learned our lesson from the last election and we fixed it. Now, the reason I bring that up with a little bit of skepticism is here's the betting markets. The betting markets. Let me make a quick comment about the betting markets. Let me give you a quick history of the betting markets real fast first. Betting markets have been around since the Revolutionary War. From the Revolutionary War to the Great Depression, if you were in the 19th century and it was an election year and you wanted to know who was leading to win the election, the New York Stock Exchange used to bet on who was going to win the election. They used to trade it right on the floor of the New York Stock Exchange. And in October of an election year like we are now, half the volume on the New York Stock Exchange would have been the futures contract betting on who's going to win. You win, you get $1. You lose, you get $0. So that's how that one worked. And all the newspapers across the country would quote the betting markets from the New York Stock Exchange. So if you were in Topeka, Kansas in 1880 for the 1880 election, the Topeka, Kansas would tell you that according to the election betting markets in the New York floor of the New York Stock Exchange, whether or not McKinley was leading or not. That's how they did it then. In the Great Depression, because of the speculation, they did initially outlaw the election betting futures, and that born the whole system of polling started by George Gallup and the Roper organization as well too. So there's your quick little history. Betting markets have been coming back. They've been coming back in a big way. What are they? All they are, in my opinion, is an aggregation of everything we know into one probability. And what usually is the case is the betting markets odds would be identical to the poll analyzer odds. But here's the election odds. Trump is at 37%. He was, and again, I'm going from the incumbent point of view. The day before, a week ago, 8 days ago, which was the day of the first debate, he was at 46%. He's not at 10 to 17. He's at 37. He is falling. He had the debate, the performance didn't go his way. He's stuck in the White House with COVID, but he has got significantly higher probabilities in the betting markets than the poll analyzers are giving him. Now, let me be clear about something here. If you look at this poll, if you look at this chart, Trump has been under 50% since May. Betting markets are saying Biden is the favorite. And Biden has never been a bigger favorite than he is right now, but it's nowhere near what the pollsters think it is. They are there. Now, why is that important? Because let me go back to before the debate. Biden was about a 60% chance of winning the election. Trump was mid-40s, somewhere in that range. Let me back up and show you this. September 25th, UK pollster Survation found that 60% of 91 investment professionals polled in September believed that Mr. Biden would win. 60%. That's identical to what the betting market was going to have. September 15th, CNBC did a survey of about 80 or so, 70 or 80 investment professionals. What is the probability Trump would win? 44%. On that day, that was identical to what the betting markets wanted to be. So what I'm trying to tell you is that the polls are telling you it's over. We're just trying to figure out how big the Biden victory is going to be. The markets are aligned with the betting markets. They think that this is a far closer race than the polls do. Now, if the betting markets and the markets are wrong, there is still significant discounting left in order to price in a Biden victory into these markets. I think that would be negative. He promises more regulation, higher taxes. That's just not good for stocks. You can stand on your head and tell me it is. It's not. He could be good for other reasons, but not for those reasons as well too. Lastly, what about the Senate? As late as a month ago, it was a dead heat. It was 55-45 before the debate. It's now 38-67. It is not a fait accompli that there's going to be a blue wave. And look, there can very well be a blue wave. In this election cycle, so many crazy things happen. I mean, it was 5 days ago that Trump went to the hospital with COVID. Who knows what's going to happen in the next 5 days, and in the next 5 days, and the next 5 days. But right now, the betting markets, which are aligned with investors, think that this is a slight Biden lead. The pollsters are telling you it's over. It's just a matter of how big it is. The last time that we saw the pollsters say it's over and it's just a matter of how big it is, 4 years ago with Hillary. But the difference was back then was the betting markets were right in line with the pollsters. And they were both equally wrong. There is a divergence. Now, they both think Biden's in the lead. So let's not discount that. They're not trying to tell you an upset. They just think it's a lot closer, meaning that if Trump could mount a rally and tighten things, it could be a lot closer than we think. That's if Trump can mount a rally and tighten things. Okay, those are my prepared remarks. I do think the bull market ended in bonds. I do think the next movement is up. I do think that volatility is set to break out. The reason I think it is because we're going to have inflation. We have reduced excess capacity because of the recession. We are stimulating demand. That should lead to higher prices as well, and that should lead to inflation. When inflation comes, all of the Fed programs, corporate bonds, high yield, ETFs, they're all going to have to stop. If they don't, the market will just keep having one bad reaction after another. Remember my analogy, the Fed is a post, the market is a horse. It's tied to the post and it's not going anywhere. But when the market gets scared, the horse gets scared, it'll rip that post out of the ground and it'll go wherever it wants to go at that point. The Fed thinks that that post is going to hold that horse there forever. We'll see. We'll see. Right now, the market is not there. The economy is definitely stalled. It is stalled for a while right now. I think that if there was any chance that the economy was going to roll over and be reflected in bond yields, it would have happened already because the Fed has been buying $3 trillion worth of bonds and is sitting on nearly a $6.5 trillion portfolio as well too. But bond yields can't fall in this environment. So I do think that that stalling is just going to lead to greater needs to spend and to just get more stimulus, more. That's just spending. Just give people money to spend, throw money out the window. And eventually they're going to do enough of it in order to maybe get inflation. And finally, the pollsters and the bettors are not quite aligned. Investors are with the bettors. Biden is leading, but it's not as nearly as big as the pollsters think. If Trump could mount some kind of a rally to tighten this race, it might be a photo finish near the end. All right, that's what I've got. I wanted to go 40 minutes. I went 43, okay, or 42. So that's good for me. Let me take it from there and let me jump in and let me answer some of the questions that you have. I see them here. Just keep shooting them in and I'll answer them as best I can as well too. Do you see a major devaluation of world currencies? This is from Byron. I guess the question is, against what are we going to see a major devaluation of major currencies? If you were to ask me, all the fiat currencies, will they devalue against things like commodity and gold? That's already happening. They're all spending money like drunken sailors. They've all got their printing presses running at their central banks. That's why I think you've started to see the moves up in commodity prices and you started to see the moves up in gold that are presaging possibly an inflation coming later on. If you're going to ask me, is the dollar going to fall? I flatly reject that argument. You got to make a case to me. The dollar is run by a bunch of reckless people and the central bank is irresponsible, but somehow there's virtue in Europe in that we want to hold the euro versus the dollar. Look, the dollar's crap. The euro is crap. The yen is crap. The pound is crap. The Swiss franc is crap. So I don't see any reason why you should have a major devaluation against another fiat currency unless you want to talk about a devaluation against a crypto or gold. So that's kind of been my argument as far as how that goes. How does the VIX respond to higher rising inflation regime? Do you expect multiples of longer duration assets, growth stocks, to compress to more shorter term assets despite the apparent growth premium applied in stocks? The VIX will respond poorly. It will go up and go up a lot. First of all, this is kind of an equity question, and I'll kind of go off into equities and offer you my opinion on equities. I do think that there's a full-blown mania going on in the equity market. And if you want to see it, look at what's happening in the options market right now. We've been trading individual stock options for 40 years. For the first time ever, starting in August, the total amount of dollars traded in the options market exceeds the dollar volume of stocks to trade every day as well. The options market is dominated by individual investors. 70% of all options that trade have 2 weeks or less to expiration. 15% of all options that trade are for one contract, up from like 18 months ago, 3% to 15. There is a full-blown mania in the options market going on right now. That's why you saw an interesting statistic that I'll give you. September 2nd, the S&P hit 3580. That's its all-time high for the moment. The VIX was 2657 on September 2nd. That is the highest VIX ever on a day that the stock market closed at an all-time high. Usually the VIX averages about 11 to 13 on all-time high days. The VIX is at nosebleed levels given how high we are in the market right now. I think it's a reflection of the amount of risk that's in the market. So if you add in inflation and you add in a bond market that is running with interest rates higher, I'll go back to the old Carville thing, James Carville, 1994. When I get reincarnated, I don't want to be a 400 hitter. I want to be the bond market. I can intimidate everybody. The bond market's ready to intimidate. It can do it in a big, big way. Let me see what some of the other questions are here as well, too. Anonymous attendee. Okay, I know you well, anonymous attendee. When inflation comes, should the broader market fail, will we see a rotation from growth into value? No, we'll see a rotation from money to money heaven is what we'll see. If so, what are the signposts you would look for in that? Look, when inflation comes, it's going to be we haven't had it. And if I could put my inflation chart up, I think the biggest problem everybody has is this idea that in all weather, in all environments, the stock market always goes up. That has been the case because as this chart here I'm showing you on slide 11, is we haven't had inflation go up for 30 years. And I'm going to define it as 2.5%. I'm not going to go to 1980 and say it's going to be 10 or something like that. I'm just going to say it's going to be 2.5%. If inflation goes up and interest rates go up, it crushes the economy. That crushes the economy. And this whole idea that everybody's going to be crushed and we're just going to continue to sit at home and pay Netflix and pay Google, I think is misconstrued. We're going to see the market go down and go down hard. And I do think, though, that the problem with growth stocks and the problem with the valuation in the market is it's already got the highest valuation in history, and it will be in bigger trouble. So what are the signposts I would look for? Is a breakout in yields. I think that yields are going to lead the way. And I think what you're going to see is if you see 80, 91%, you're going to get the great Wall Street refrain. No one on Wall Street's allowed to be bullish except bearish on anything. You can't be bearish on anything except for bonds. You can be bearish on bonds and think because higher yields, you could break out and God bless America because it means the economy's getting better. Sometimes it means that. Sometimes it means something else. And in this case, I think if you see a breakout in yields, everybody will sing God bless America and tell you that means the economy's getting better. Send Jay Powell to Oslo to give him the Nobel Prize in economics. But I think it means that inflation is coming. And I think that that's going to be your warning sign. I know that's what the Fed wants. Careful of what you get. Be careful of what you wish for. You may not rue the day when you get it as well, too. Mark asked, my question pertains to the business cycle model. Do you have any insights, comments in terms of what stage we are possibly in? The only comment I would give you is that there is no business cycle for a shutdown and a reopening. We have no example of how to follow what is going on right now in the economy. This is unlike anything else that we've ever seen. And I'll come back to my argument again. Let's say I'm wrong. Let's say you invite me back here in 12 to 18 months. Jim, you said there was going to be inflation and there wasn't going to be any inflation. We're going to be full-blown MMT. And modern monetary theory, what is that in 2 seconds? That is the idea that the government, if you borrow in your own currency, and the US dollar does, and it's the reserve currency, you can just borrow the money that you want to spend. The government can borrow the money it wants to spend. It doesn't need to tax it. We don't need to raise taxes. We could cut taxes and we could just borrow it all. Eventually, MMTers get a bad rap because they do say that eventually there is a level of borrowing out there that when you borrow too much, there will be a return of inflation. They've argued that it's much, much higher than people think. I think prescriptively, they're right. The chart you're looking at right now, we're 15% of GDP on the deficit. Prior to this pandemic, every economist would have told you, man, if we ever got back to that point, there'd have to be inflation because all that $3 trillion of spending, buying stuff would have been bidding up prices. Well, we did it without it. And the MMTers say that we are. I do think that there is a level out there. And what I'm arguing is we're going to have a stimulus package. And if we don't get an inflation, we're going to have another one and another one. And especially if Biden is the president, and especially if the Senate is Democrat, we're just going to keep borrowing and borrowing and borrowing until we produce inflation. Because why are you stopping? If you're giving people $400 a week for unemployment and it doesn't, and the stock market's okay with it, and interest rates are okay with it, then give them 500, give them 600, give them 700. Why would you stop? You will only stop when the market has a toxic reaction to it. And that's ultimately the way that I think we're going to go with this. So the business cycle, this is not a business cycle. We've never voluntarily shut down a major economy and tried to restart it again. And so really the question is, becomes then at that point is, where do we go from here? What will be the impact on emerging economies of stalling US economy and the impact on oil? Bad. Emerging economies are economies that make stuff to produce to give to the Western world. Not only is our economy stalling, Europe is stalling. Europe is having a second corona wave virus. They're rolling back their lockdowns. They're going to stall even more. The emerging markets are going to struggle. Oil right now, other than it's getting a bid because Hurricane Delta in the Gulf is going to threaten a lot of the oil platforms in the Gulf. But beyond that short-term talk, it suggests a slowing of demand for oil as well too. That's why I think it was slowing, and you were in the high 30s, $37 or so, and on its way down until Delta showed up and might break some of the platforms and create a supply shortage that it popped back above 40. If Biden and the Democrats, here's another anonymous attendee. If Biden and the Democrats win, how would the market react in the next 6 months? Now, I'm going to talk about how the market would react. That doesn't mean that there are other aspects of a Biden Senate that might not be perceived as better or worse. But I think that if you were to ask me the question, we all thought, not we, Paul Krugman was convinced that on November 8th, 2016, that the Trump victory was going to kick off a depression and the worst stock market correction ever. And he couldn't have possibly been more wrong. Why was he wrong? Because Trump did three things. One, he massively cut regulation. 2, he cut taxes. And 3, he's been favorable to the business community. If you get Biden and the Democrats and they want to raise taxes, reimpose regulation, and talk about the evils of business and how you must be protected from them and not trust them, I think all things being equal, that's going to be negative for the stock market. Those events. Now, there are other things that could come along, maybe a vaccine, maybe a complete restart of the economy off of a vaccine that could overwhelm that, but he's a negative. But he's not the only thing that could happen. A medical bailout of the economy could definitely help quite a bit as well too, to offset that. We'll see. whether or not there is a vaccine, whether or not people take it, whether or not it's effective. But that, there is, I've always leery about what I call the one factor model. If Biden does this, it will be negative for the stock market, but there are other things that could offset it, but it would definitely be a negative for it too. What is my opinion about cryptocurrencies? I ultimately believe that a crypto will be the next reserve currency. I do think that's a ways away. We're not going to replace the dollar with the yen or the euro or the yuan or any of those other fiats. It's just not going to happen. The dollar's going to be replaced by a crypto. Yeah, the euro and the dollar and the Fed are going to try digital dollars, but at the end of the day, I think a crypto is going to take over. I don't know which one it's going to be. I don't know if it's going to be Bitcoin, Ether, stablecoin, or any of the ones that we have, or one that's coming. I do think longer term, cryptos are going to be the place that we're going to go with payment and mediums of exchange, which is what the dollar is. It's in its infancy. Eric asks, junk bonds, high yield, Fed, do not much at the end. Your view on did not do much in the end on junk bonds, high yield. View on spreads. All right, investment grade spreads. Investment grade spreads are tight. They're going to stay tight. The Fed is got that market controlled. Investors are saying, here's an investment grade deal, buy. By the way, what did I just buy? It doesn't matter because the Fed's buying it too, and the Fed's not going to let the market go down. That's why we've had more investment grade issuance this year than any year ever, and it's only October 7th. So every day we keep setting a new record. And that's why spreads are so tight, because at the end of the day, there is an expectation that the Fed is co-investing with you. They've got a printing press. They're going to keep spreads tight. High yield bonds, the spreads are very correlated with equities. They are unusually tight because the Fed does buy some high yield. Anything downgraded after March 22nd was eligible for the Fed to buy. So they can buy Ford, but they can't buy Oxy. Oxy was downgraded March 18th as well. And they also are playing in the high yield ETFs as well too, through their ETF purchases. So I suspect that what you've got with high yield right now is a little less beta to the stock market. It widens when the stock market goes down, it narrows when the stock market goes up, but not as much as it used to because you've got the heavy hand of the Fed involvement in there as well. Birdie asks, what is your view on the effort of the U.S. to mediate agreements between Israel and the UAE, and let's expand it to the Gulf Coast, Gulf Cooperation Council, and the effect of the new Iranian influence in the conflict in the region and foreign policy yardage that Trump may gain out of this? Could this have a greater global impact than China trade resolution? Boy, that's a real foreign policy question, and that's out of my bailiwick. But I will say, yes, I do think that that is an important, that is a significant impact of what's happening there, but it has no play in this election at all. Whether or not Trump is wearing a mask at this minute plays a lot more than that. But I think longer term, we're all going to forget whether or not Trump wore a mask, whether he wins or loses, and that I think that the deal between Israel and the UAE is going to be significant. And I'll leave it at that. Richard asks, where do you see funds invested in the bond market moving as interest rates head higher? Other than high volatility, high volatile commodities, what options are there to protect corps from a higher vol regime? If I'm right and we get inflation, and I've made this point before, you might see the 10-year yield go to 1.25 to 1.5 by next summer. If you do the math, you might be sitting with a 3% loss, 4% loss in the 10-year yield if you bought it now and the yields went up that much. If I'm right and yields went up that much, I think the only reason that they would go up that much is a fear of inflation. You'll lose 10 to 20% in the stock market. The stock market is, well, if inflation returns, it will rip the stock market. I do not accept that argument that the stock market is an inflation protection, provides inflation protection. That was an early 70s argument that did not work by the late 70s. My point is, I do think that if you were to get that, you will have a flow from riskier assets that are suffering under the weight of a higher yields, slower growth because of inflation and uncertainty, flowing into, I'm happy to own treasuries because I might lose 1% in them as opposed to 10 or 20% in equities. So I think that that would be your natural offset to that as well too. As far as what fixed income investors will do, they'll shorten their duration. They'll run into the 2-year note. They'll run into something shorter if they can. The possibility there exists that, you know, that those yields will still stay anchored somewhere around zero. NJ asks, I got just a couple more questions here. If Reuters, you want to jump back on the line, but NJ asks, what do you believe a rebacking of gold-backed dollars per Judy Shelton is? Well, first of all, I have been a fan of Judy Shelton's. I think that she's a heterodox thinker. She's exactly what a consensus thinking, uncreative Federal Reserve needs, is some kind of outside of the box thinker. Please don't tell me she's going to be a stooge of the administration. Powell is already doing, in my opinion, inappropriate things by negotiating the stimulus deal with Pelosi and with Mnuchin. Lael Brainerd is already shown that she's just a partisan Democrat, and she objects to anything that the Republicans might like on the board, and she's favored to be the Treasury Secretary under Biden, like she was when Clinton was running 4 years ago, and she donated to the Clinton campaign. Lael Brainerd is no different than Judy Shelton on the left, Brainerd on the left, Shelton on the right. Let's get some new blood, new thinking in there. So I'm a favor of Shelton. Rebacking of gold-backed dollar per Shelton. That's not going to happen. She will bring in a different opinion. They will circle the wagons and try and shut her out. But I am favor for her as well too. Dominic asks, thoughts on gold would be much appreciated. Higher. I think higher. I think the problem with gold though is that there's a tremendous amount of speculation in gold. So it's going to continue with a lot of this volatility, but I think it's going to continue to go up as well too. Won't the money market liquidity factor for the bond market be rolled over and keep the yields moderate? The money market liquidity factor for the bond market to be rolled over and keep yields moderate. Avoid higher yield. Hence, inflation is not affected. It is the money multiplier being used to further borrow within the country. I thought the money multiplier stopped working before I joined Wall Street in the mid-1980s. That everywhere and always a monetary phenomena is definitely not been something that has worked. And I don't think it's something that's going to work. I'm talking about less stuff, more demand. That is, we've got an economy that is in recession. We are trying to hand people money to buy stuff. That's going to lead to higher prices, which is inflation. I've not made the argument that it is going to be a monetary effect. And I think because it's not going to be a monetary effect, I don't think that liquidity or the multiplier or any of that stuff is going to matter. And I think one of the reasons that the multiplier doesn't work is I don't know what money is. M2 is some of money. It's not all of money. Money is a lot of different things, and it can have a much broader appeal. And I don't think it's a much broader base as to what money is. And I don't think it's necessarily measurable too. Eric asks, 2 more questions here. Eric asks, what are your views on ECB policies? ECB's got a real problem on their hands. They got a second wave coming. They don't know how to deal with it right now. Lagarde is kind of trapped between a lot of different factions at the ECB. So they're going to be stuck with negative interest rates. They're going to be stuck with buying bonds through their TLTRO programs. And I just don't see them changing their policy much in any direction, which way. Their fight is that if their economy slows, should they go more negative? But I think they now understand it's a bad idea and that they can't undo it because it looks like they're tightening and they don't want to make it worse. They're not in a very good place from there. And so we'll go from there. All right. I've run a little bit over my 1 hour. We're at 64 minutes. I guess we're going to end it here. Reuters, are you going to jump back on and say goodbye, or should I just sign off from here as well? I'll give them a second.
I'm back, Jim. I just wanted to jump in and thank you so much for such an insightful session. too many questions and not enough time, we'll have to invite you again.
Sure, I look forward to it. Thank you very much.
Thanks again, and thanks everybody for tuning in. All right. Goodbye.